The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another excellent edition of the Power Trading Hour with me, your humble, lovable, and squeezably soft host, David White, as we meet each day between 2 and 3 Eastern Time and discuss the market. And of course, today, a little bit of country, a little bit of rock and roll. This market doesn't know which way is up right now. In fact, we just need to wait a few minutes to find out. But off 2.5 points, a lot of volume so far today. 2.5 billion shares on the New York Consolidated Tape. That's probably the strongest Friday this year, I would imagine, at least at this time. And I imagine we're going to have a great deal more volume before the end of the day. I think we have the opportunity for lower prices. And we'll see probably come on Monday. Have a feeling, I thought that a lot of these funds that needed to buy for window dressing would wait till Monday. It looked to me like they came in and stepped in when they hit that 1920. And every time they get a sell-off, they kind of step back in. So it looks like fund buying starting today. Looks like it will probably go into Monday now. So we'll probably have a little bit of a floor under the market. May even close positive here today. But the volume is telling you everything, and that's the last few runs out here. Huge volume and lighter volume in the upsides. But we've got plenty of time for our hands to play out, and we'll be watching that. Anyway, when we look at the rest of the markets, gold's up 12 bucks. Silver's basically flat off 2 cents. Crude, when we look at it, it is off 42 cents now. And a few of these things coming back. A lot of discussion on Bloomberg and CNBC about, you just need to buy. You need to buy. You need to buy. I haven't really seen that kind of, or any kind of worry that would make me think that some kind of medium-term or even short-term low is in. And my guess is that when the fund buying evaporates, most likely on Monday, that will be our opportunity. We broke through the 1938 level, which sets up probably about 1870, 1880 on the S&P cash. And we've had a great deal of volume out here. I know that the desire to buy is strong in the market right now. And the question is whether or not everybody will dive back in. Pretty much seeing exactly what we've seen today, what we've seen before, and that is everybody wants to buy the dip. As soon as you hit unchanged on the day, the volume turns to dust, and you go kind of pop back down. And today, probably the most interesting thing is going to be that last 30 minutes of trading. My guess is tons and tons of volume. Going to be maybe a match out here. Bulls are going to probably declare this as a victory if it doesn't close at the absolute lows. I thought it would probably run into Friday's close and probably give us an opportunity to if you wanted to, cover some of your shorts. My guess is that's going to be next week now. If they're using their powder today, that pretty much sets up not a lot left in the tank come Monday. The S&P just actually went flat on the day right now. But a ton of a volume out here as we look at some of the different sectors in this market. Of course, that still leaves us down 50 points, 55 points off the highs in the S&P cash. And, of course, we did have a lot of volume. So maybe the first warning sign, maybe continuation, we'll have to look next week. I think that, and I wrote it in my newsletter, that one of the books I love the best and taught me the most about trading, I really didn't talk about trading so much as the psychology of it, and that was Reminiscence of a Stock Operator. That book, there's a passage in there that basically says making the big money didn't have to do a lot with me thinking. I'd already done my thinking. The making the big money had to do with me sitting on my hands and not thinking too much and just letting my hand play out. And I think, as I am short, that we're probably going to be looking for that. And we're going to have a lot of these very short, very brisk pulls and pushes in the market. But what and where the big money is going to be is in the long-term trend, not in these individual fluctuations over 30 minutes or 60 months or an hour. In fact, I think somebody emailed me yesterday about a 5-minute or 10-minute or 15-minute chart in the S&P yesterday, and to me, it was like looking 5 feet ahead when you're driving 60 miles an hour. I want to be looking up way around the corner and not get that sense of speed like you're looking straight down at the pavement. The only way to drive. But anyway, trying to push this market back up again at unchanged, and we'll continue watching that. But again, like I said, it's almost always we see the volume as soon as you hit unchanged on the day for probably the last 7 trading days, just the volume really tapping out. At the bottom of the hour, we're going to have Andy Heck call in. He met some of the guys from Long-Term Capital Management, and the whole discussion is probably apropos right now because we have a lot of people that believe the market can only go one way, and there's probably no better example of a market that only goes one way than Long-Term Capital Management. We'll discuss more of it and why it is so important to traders to know about the smartest guys in the room. In fact, there's a book called When Genius Fails. In fact, there's 4 books about long-term capital management, and maybe we'll get into them with Andy. I've read all 4 of them, and of course that was right after the .com blew up, and I was very interested in what made bubbles and what made markets go down. In history today, in 1897, looking for a remedy for his father's rheumatism, a young German chemist named Felix Hoffmann synthesizes a stable form of acetylene acid. I can't even say it correctly. In a laboratory in Berlin, the head of the Bayer Pharmaceutical Institute lambaste Hoffmann's discovery is typical Berlin hot air. The product is worthless. Bayer soon names the product aspirin. It becomes the best-selling drug of all time, and comes from tree bark, if you didn't know it. Distilled tree bark. And Indians were actually using it as aspirin and boiling it down long before the European man came over here and gave him his 2-bear aspirin. But what a giant business that created after time. Of course, I've been hot on this quote for a while, and that is, markets don't culminate in one grand blaze of glory, and that all truth passes through 3 phases. First, it's ridiculed. Secondly, it's violently opposed, which I think we're in that camp right now. It just can't go any lower. We're going to go higher. And third, it's accepted as being self-evident. I think next week we're probably going to see that people start saying that a pullback, oh, I've known it all along. And of course, can't find too many people other than here at TFNN offering a contrary view. Like I said, I'm probably going to get into long-term capital management after the break. But one of the things, especially if you've ever gone to Las Vegas, everybody's going to give you a scheme. And part of the scheme from long-term capital management is basically something like a martingale. And this background for betting is very important because generally this is the way people lose all their cash in Las Vegas. If you bet, you make the same bet again. If you lose, you double your last bet. This will ensure that you hedge your losses and keep your winnings. Well, absolutely perfect in theory, absolutely garbage in practice. But you can see how people lose billions and billions of dollars buying into this. And if you have unlimited money, i.e. you're the government, you could maybe make this work for a long time. And in my beliefs, this is exactly what the Fed has done. They keep doubling down, keep doubling down, keep doubling down, and in theory they have all the money in the world. In practice, it only lasts so long. So we've started to see the FOMC out here today, at least one of the gentlemen calling for a January hike in interest rates. I think that was Fisher, wasn't it, from Dallas? And as we see him call for it, made some weakness in the markets earlier this morning, and I think everybody's kind of coming back. I've heard probably 5 times that he didn't say what he said already today, which is good. We want to see a lot of people violently oppose the belief in higher interest rates, but basically he's saying in January, I thought that maybe the day after elections, and now the argument isn't whether they're going to raise rates next year, it's when they're going to raise them. And I think that is the first step. Somebody says they thought it was Plosser this morning. So thank you. I thought it was Fisher, but maybe it was Plosser. But those Fed guys don't go out there and just spout their mouth off. Normally they all get together and say, hey, I'm going to say this. And if they all say, no way, then generally they don't. They don't just go off shooting their mouths off. So I think that there's a little bit of it. But to me, it's kind of like aliens in the United States. There's always this big plan. If someone did find a real alien, that we'd have to probably take 10 or 15 or 20 years getting the public ready, because the public just would not be ready to find out that there were aliens in the world. So we're going to make some movies about aliens. We're going to fly some spaceships over, and over a number of years we're going to get them kind of used to the idea of the aliens. And then we're going to pop it on them. It's not going to be any big deal. We've pretty much talked them into the idea. And this is exactly why some of these is talking about those things. But yeah, we've got huge issues in the rest of the world. And part of those huge issues are overheating the economy, and pretty much why we are looking at a market that's down 50 points off the S&P highs. And people trying to fight out here. Now, the weakest stocks, of course, will be small caps. Mid caps are starting to roll over now. And my guess is we're probably going to start seeing the big caps next week start to show weakness. When we come back, a little bit more about long-term capital management, maybe a few charts, bottom of the hour, Andy Heck, and we'll talk about long-term capital management on a day that we're waiting for the market to make up its mind.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, Visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
We had some stocks out after the bell last night, and I just wanted to cover a couple of them in this segment before we get started with long-term capital management and a well-deserved weekend. Now that we're looking at the markets out here. Of course, we're going to be watching them very close before the end of the day. Flat on the S&P cash, closing in on 2.6 billion shares on the New York Consolidated Tape. Expedia came out with earnings, nice little pop out here today. It's given back half of it. I don't think you can really make anything out of this one. This one's still in its uptrend line. You'd need to see some kind of physical change. Doesn't seem like the market thinks that interest rates are going to affect it too much. More interestingly to me is the response to LinkedIn. And get it here. And LinkedIn, nice little pop out here. To me, when we look at the social network stocks, if I was a long-term player, I would think that LinkedIn offered a lot more predictability and long-term profits than some of the other stocks like Facebook and the other social network stocks. You know who you're dealing with, you've figured out how to advertise them to them, and there's a fairly long-term, long-scale reason for being on LinkedIn. I am not. I believe all these things are horrible cults, but the world does not agree with me. Anyway, LinkedIn, a lot of volume out here, a lot of pop back, and of course, huge trading range out here. And when you look at this, I just wanted to, I think I pointed this out when it was on the show when it was out here, but if you wanted to buy a stock and you like price and volume trading, that's all you really needed to do. This thing had a huge gap up on the 8th of February with almost 14 million shares. Got back into it with 5 million shares. And if you were bullish in the market, if you didn't buy that, I think you had to have your head examined. Of course, I've been kind of bearish for a while. And, of course, making money now. But these are not some of the worst-looking stocks out here. What I do have to say is the energy so far is not overwhelming on the way back up, although maybe today and a few more days in the future we could get it. Right now, if we had a little pop in the market, it looks like this would want to go back up to probably about 230, and probably setting up a big trading range in the stock if the market does weaken out here from somewhere around 140 to 220 bucks. This may be one of the biggest traders that we can look at in the near future. As we said, we're going to come back after the break and talk with Andy Heck about long-term capital management. He traded with these folks at Solomon Brothers and knew them and called them names. Very bad names. Andy, it's time to put $1 in the jar. You know it is. Anyway, when we come back, we're going to look at these. But John Meriwether, a couple of Nobel Prize guys, and suddenly you've got books about the smartest guys in the room, When Genius Failed, Paving Wall Street with Cash, and all ending up in a giant hole with fire and smoke coming out of it where they augured into the ground at the end. Hubris is one of those things in a trader that is deadly. Unfortunately, all these guys thought that they were smarter than everybody in the world. And when you think that, it's problematic, especially for people over the last few weeks that have called in and keep thinking that the Fed is bigger than the markets. It doesn't matter how big you get. These guys were rather large. But it is one of those things where you've got people that were, winning Nobel Prizes for coming up with a Black-Scholes derivative way of playing pricing options, all kinds of other stuff. They had the latest technologies, Ito's, what they called Ito's machine gun, Ito's formula for figuring out how they could corner the market in bonds, and bonds in a lot of foreign countries. But out of the peso problem, out of the problem with Russia, it was finally their undoing. You are not, or no single person is ever bigger than the market. Neither is the Fed, neither is the United States. Eventually, the cure for a high price is a high price, and the cure for a low price is a low price. And probably a good day for talking about this, why the market's fighting the bulls and bears, and right now it's pretty much a draw. We'll be back with Andy Heck after the break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra extra edge when it comes to trading and investments? Then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
And as we come back, we should have Andy Heck on the air right now.
Hello, David.
Howdy, Andy.
Howdy.
And one of the reasons I wanted to bring this up this week and was even thinking about it is the Congressional Budget Office, CBO, did a kind of a review now that we've had several years on Dodd-Frank to see whether we're too big to fail again. And where all the loans were concentrated, or 20%, or excuse me, 20% of the loans were concentrated in 5 or 6 banks in 2007 and 2008. That number now is about 60% in the top 5 or 6 banks. So instead of getting too big to fail and diversifying banks, we've actually gone the other way. And like most things, people in the in Congress fairly don't understand stock markets at all, and of course pass worthless laws and get us into even bigger trouble down the road. But 2008 wasn't the first bailouts in the financial markets, and you had kind of a very close view of that with a company called Long-Term Capital Management. Why don't you tell us why you think it's important and your experiences since you've met the guys that were involved?
Well, I want to tell a little story, David, that I think will drive home the point of actually the way these guys operated and what they did and how they looked at the world. And I think by understanding how they looked at the world, you'll understand what the problems are. So in 1991, I ran all of the precious metals and some of the base metals business for Philip Brothers. But Philip Brothers went down the tubes. We were a division of Solomon Inc., and they closed my division. And I was one of two profitable trading divisions. So they took my business and put it into Solomon Brothers. And I came under the fixed income department at Solomon Brothers. And my boss, who was the treasurer, reported to his boss, who was John Merriweather. So I had a lot of interaction with Merriweather. Now, I sat in the middle of this fixed income trading floor, David, and 2 desks over was this very elusive bunch of guys called the ARB department, arbitrage department. And what they did is that it was always, all in a trading room, you always hear screaming and crazy. On that desk, it was very, very quiet. All they would do, they played a lot of liar's poker. They kind of sat and looked at their screens. But they were the crown princes of the trading floor because they made all the money. So, just as an aside, when John Goodfriend, the big honcho, the king of Wall Street, used to come down to the trading floor, he would just make a beeline over to those guys, ignoring everyone else. Because, these are the guys who were making $400, $500, $600 million a quarter for the division. Anyway, there was a group of guys there. The most aggressive guy was a guy named Larry Hildebrand. I don't know if you know that name. You read the book, so you probably know the name.
I read 4 books, so yeah. Unfortunately, it was about 10 years ago, but yeah, I've read all the books.
So Larry had gotten some fame the year before, in '90, when he got a $23 million bonus. He was about my age. He was about 30 years old at the time, and his face was on the cover of the New York Post, the $23 million man. But he was the most aggressive guy there. There was another guy, Eric Rosenfeld, who was a professor at Harvard, who Merriweather plucked out of there. There's a guy, Victor Hagnani, and then there was the older guys, Fisher, Myron Scholes, the famed creator of the
Black Scholes,
with Fisher Black, the Black Scholes option pricing model. So all these guys would sit there. And when I got down to Solomon, I had a meeting with these guys after I was there for about a month or so. And I explained to them my business. And I explained to them that the franchise of my business was borrowing gold from central banks and lending it to producers. So central banks would lend their gold like deposits for an average of about 30 basis points every 3 months, and they'd roll these gold loans. And we would take in that gold and pay the fee for it, and then sell spot and buy forward. And what we did there, the ability to borrow gold gave us the ability to buy forward from producers who were hedging their gold. Remember, gold at the time was about, between $300 and $400 an ounce. I had a book of about 1.25 million ounces of central bank gold, which was somewhere around $500 million notional value. And I would use that central bank those central bank gold loans to do producer hedging, and I would make about $15 million a year as a franchise, just taking the risk of borrowing gold for 3 months and loaning it to producers by buying forward from them for 2 years, 3 years, 4 years. And there was risk involved in that because, I'd borrow for 3 months and I'd lend for 2, 3, and 4 years. So I sat there, I explained this business, and Larry Hildebrand and Myron Scholes said to me, "Wow, that's a great business. Let's do it 100 times bigger." I said to them, I'd love to. I'd love to make, $1.5 billion a year or whatever it is, or even 10 times bigger. But you tell me, what happens if the central banks don't lend us gold? What happens if something happens to our balance sheet and we're downgraded and I can't borrow the central bank gold? Or what happens, I didn't say this, but a year later there was a treasury auction scandal where the central banks cut us off totally. I said, if I'm caught in a position where I can't borrow this central bank gold, then I have to go, I'm short. when I return this gold, I have to go and buy it in the market. Do you realize the kind of losses that could create? They said to me, we'll worry about that. You just do it as big as you can. And I said to them, I'm not doing that. I'm not doing that. That would be totally, unethical and the risk reward. And then they did a VAR analysis, and they said, come on, the VAR is not that much. A black swan event, you're talking about a black swan event. If we only looked at things in terms of a black swan event, a 10 standard deviation move, we'd never make any money. And then they used some choice words to me to try to kind of get me to really ramp this business up. But I just refused. I just sat there and refused. So, I mean, in a nutshell, they wanted me to, instead of lending 1.25 million ounces of gold to producers, and even by doing structures in the market where I sold spot and bought forward to get this differential, they wanted me to start doing 12 million, 100 million ounces of gold. And I couldn't do it. So when they blew up in, what was it, 97, 98?
It was in 98 because I started full-time trading about 6 weeks before that happened.
Okay. So when they blew up, I'm sitting there thinking about this thing. And, there was a lot of funny anecdotes. Merriweather was in the room and he introduced everyone. He goes, I'm sure you know who Dr. Scholes is. I said, yeah, I think I have his foot pads in my shoe. And of course, out of that bunch, no one laughed. But what a very interesting bunch. They were brilliant people, no question, really brilliant people, but hubris. And, the problem was that they got themselves into positions. What they did in long-term capital management, as you know, is they took big arbitrage positions, third world debt against U.S. bonds, and on a mega leveraged basis. And that's where they got, blown to kingdom come. And they actually had to be bailed out. They could have brought down, a lot of the banking system at the time.
But their idea was that eventually everything has to come back to some kind of normal.
They were mean reversion boys.
Right. And so the idea is if we just hang out long enough, and if it goes against us, we just add more. And if it goes against us, we just add more. And eventually it's going to come back, and that's going to be it.
That's exactly right. And when we had that discussion, David, and I said to them, the average central bank lending rate for gold is 30 basis points. They said, well, if you can lend at 2.5 and borrow at 30, why wouldn't you just do it with all the gold in the world? I said, because we're Solomon Brothers. We're not the kings of the world. So, and they said, well, if it goes against us, we'll just wait till it comes back. I said, but what happens when I have, when this 3-month loan comes due and I don't have the gold to replace it? What happens if I have to buy it in the market? And they kind of dismissed it. And they basically said that I was risk averse when I didn't want to do it. And I was like, oh, I'll do it. I would do it leverage 2-to-1 maybe. I said, but 10-to-1, 100-to-1, and Larry Hildebrand said to me, I think he said to me, oh, do you want to become a made man here at Solomon? I said, I said to him, no, I don't want to go down in history as the guy who blew up the place.
Well, I was going to say that these books, the guy that just wrote Flash Boys wrote a book about it, Roger Lowenstein. You can find these books pretty much all over Amazon, and they go through what is a story of hubris and also kind of a martingale belief that if they just keep doubling up, everything will come back and work out in the end.
Yeah.
The problem I have is most people continue to think that the Fed can do anything it wants because it can print money. But at some point, the markets, even in the world, will dominate and go over the U.S. markets. So I kind of look at this as kind of almost a biblical tale of people that continue to believe that if they just keep doubling up, if they just throw more money at it, eventually things will go their way. And unfortunately, even if the United States printed all the money in the world, eventually that would catch up with us, with other countries, because we aren't the sole printer of cash in the world, right?
Absolutely, absolutely. You know, the interesting thing here is, you know, a lot of people blame Merriweather. Merriweather was a very interesting guy. Did you ever read this book called Bringing Down the House by Ben Mesrick?
Yes, I did.
Right. So remember the guy who was the professor who was the leader?
Yes.
Merriweather was very much like that. He was very quiet. He was very cerebral. Used to, you know, basically had his boys would come to him with trades, and he would, you know, give his approval, but he was very quiet. And actually, after the meeting where I took them on, he actually came over to me and slapped me on the back, and he said to me, that was good. I'm glad you took them on. He didn't say, you know, oh, you're right or anything like that, but he said, oh, I like the contra. It's good. The tension's good. So it was really a very interesting. And I have to tell you, I think that, you know, for the listeners, it's a cautionary tale, because leverage, and they didn't call it leverage at the time. They called it lambda because they like to speak in Greek. Right? They were very, very quantitative traders. Lambda, leverage, gearing, a very dangerous thing when used inappropriately on some of these mean reversion trades. You know, we've been. History's been repeating itself over and over and over again. We saw it with long-term capital management. We saw it with Barings. We saw it with, you know, a number of other Lehman Brothers, exactly. Bear Stearns. We saw it with, I'm trying to Amaranth, that big hedge fund that blew up in natural gas. There's a lot of risks in some of these structures that are put on, and some of them become so complicated that those who are assigned to basically monitor the risk really kind of get lost in the sauce and don't even understand it and have to go back to the traders. The traders in those days used to mark their own bucks. At the end of the quarter, they'd put their own prices on those bonds.
Yep.
So, very interesting. And really, we can all learn a lot from what happened there. I mean, I was blessed to be very close to what happened there. And by the way, as an aside and as an addendum and following up on that story, less than a year later, the guy who ran the U.S. bond trading desk there, Paul Moser, he actually was very jealous of the paychecks that the R boys were getting. So he ramped up the risk in the auctions, and he wound up bringing down the firm.
Yep. Now, most people don't understand. They go, okay, well, I've never heard of this. It never really happened. You know, it's like World War II to somebody born in 1960. Most of the time, some great movies, but, you know, nothing really that I can see, because when I was trading, it didn't happen. Of course, I was born into fire when it did happen. And 6 weeks into becoming a full-time trader, seeing a market down, 500 or 600 points on the Dow, which would be kind of like today if it was down 2,000 points. And having the president of the Fed come walk in and turn the market so you close 500 points up. So it would be like being down 2,000 points on the Dow and being up 2,000 points on the Dow in the same day. Because they came in and said, okay, we're going to bail these guys out. And by bailing them out, they probably set up the next round of probably the housing issue, because it's pretty much the same thing. We'll be back in just a minute. Hopefully Andy can hang on with us for the last little segment.
Sure.
We'll be back in a minute, folks.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days, unconditionally, so there's no risk to you, other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Tom O'Brien, founder and CEO of TFNN, professional trader and educator. Also a special guest on CNBC, analyzing the commodity markets. Tom will bisect and dissect the markets. The Tom O'Brien Show, next on TFNN.
And as we come back, we're finishing up, and it just I kind of assumed today would be a little bit of country and a little bit of rock and roll for the market as it tried to decide what was going on. I still think we probably sell off into the weekend as the market is not going up. Off at 3 points on the S&P cash, 2.75 billion shares going into 3 o'clock, which is probably one of the strongest days in 9 months, maybe longer on a Friday. So we've got energy to the downside, and I think we're going to have a lot of people fight probably down to 1870 on the S&P cash. So I'm sitting on my hands on my trades, and we're going to let them play out. We are talking with Andy Heck, our commodities expert at TFNN, and the Ask.com expert on commodities.
About.com.
About.com, excuse me, Ask.
That's okay.
About. But it is, we're talking about long-term capital management, very important because they did bail them out, setting it up. We were talking a little bit before the break about the not the CBOE, the Congressional Budget Office, showing that we're even more stuck with too big to fail, with almost all of the top 5 banks now getting loans, getting priority for getting lower interest rates, just about everything. So we're making a market that is more fragile, not less. And I think, for the most part, there were some cons going on out there, but there wasn't a pyramid scheme like this. This was kind of the first one, and a lot of people figured out how to do it after these guys. Of course, they all blew up because the problem is eventually you run out of other people's money, or the market goes against you, and that's it. So when you think about this now, 16 years later, after it blew up, when it was blowing up, I mean, you kind of knew already that these guys were just nuts, right?
Well, I mean, it was hard to argue with it. They were putting up huge profits, but, it really came to light. It really came to light to me when they made their suggestions on the business that I knew. And I said, if they are making that suggestion here, what are they doing in the bond market? And that the light bulb went off.
For people that didn't understand, a lot of times hedge funds will run somewhere between 15 and 25 or maybe 30 to 1. So if the market goes against them a little bit, they're wiped out.
Right.
Okay. These guys were going 100, 200, 300 to 1. If it went against them, they just bought more.
Right.
Okay. They could keep the price by just firing away at the market, but people were going, hey, these guys will buy a pound of lead that sells for 15 cents for 25 cents. I'll just keep hopping it on them. And, of course, they kept eating it, and everybody was going, well, if they'll take that, I'll give them some more.
Exactly. And on days like yesterday, which was the end of the month or the end of a profit period or an end of a quarter or an end of a year, they would come and they would basically make the price by doing some trades at the price that they wanted to close at.
Window dressing.
Exactly.
So these things can go on a long time. Eventually, you have to pay the piper, and probably a good reason why martingales are a bad idea. I know you live in Las Vegas, so you know that almost all the suckers and the fish out there at where are the fish these days? Which
fish? Anyone who's in any casino is a fish. But at the poker rooms, they're probably late at night. They're at the Wynn and the Bellagio.
Bellagio, yeah.
Yeah.
I talked to a few people that say that's where they go to get the fish.
Yeah.
For people that don't gamble, that's people that don't know what they're doing. Anyway, I want to thank you for the call. Hang on just a minute. We're going to have Tom O'Brien wrapping up the end of the day for us, and then I'm back at 4 o'clock with the Tech Insider. Thanks again, Andy. See you all on Monday at 2 o'clock. We meet again. See you then.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.